Welcome back, folks. This is the third teaching of 8 from the December content of the ICT mentorship. We're going to be talking about reinforcing order block theory, selecting and avoiding. And we're going to first talk about the bullish order block. Everything I say here, you'll just reverse for a bearish order block to save time. Definition of a bullish order block is the lowest candle or price bar with a down close that has the most range between open to close and is near a support level. Validation of a bullish order block is when the high of the lowest down candle or price bar is traded through by a later formed candle or price bar. Entry techniques using a bullish order block. When price trades higher away from the bullish order block and then returns to the bullish order block candle or price bar high, this is bullish and can be used for a bullish entry. Defining risk with bullish order block. The low of the bullish order block is the location of a relatively safe stop loss placement. Just below the 50% of the order block total range is also considered to be a good location to raise the stop loss after price runs away from the bullish order block to reduce risk when applicable. Okay, let's take a look at a supposed support line. Now that can be in the form of an old low on a long-term or higher time frame chart. It could be an old high where price has moved above recently and now we're trading back down into it. So simple support resistance ideas are just enough here, but the main thing is you want to be using it on a higher time frame charts like a monthly, weekly, or daily. And eventually you'll see price trade down into this level that you identified as a support level. Once price trades down into the support level, and it could trade to it or just through it, doesn't make a difference. But what we're doing is we're waiting for price to show us indications that smart money or a large body of big flows, or those individuals that are on an institutional level that have a whole lot more collectively than we do in terms of money, when they participate in a move, it'll be seen in price action. So when we have this down candle, we have already assuming that this may be a bullish order block. We don't know that yet until at a later time when another candle trades through it. What are we specifically aiming for or identifying our focus? The down candle's high, when that is violated with a new candle and it trades through that high, now we have a validated bullish order block. This candle validates the down candle as a bullish order block. Now at this moment, if we trade back down, once that down candle or suspected bullish order block's high is violated, we can now highlight that candle's high, and even in the very candle that broke that down candle's high, if it trades back down to that down candle's high or the bullish order block's high, that could be a retraded price that which we could day trade off of or enter our longs early. In other words, we don't have to wait for a later time for it to trade back down into this level. Eventually, price will run away. At this point, if you didn't enter on a retrade at the bullish order block's high, you're simply going to be waiting for price to want to pull back. Now we have indications that there has been displacement in the marketplace. That means someone with a whole lot of money and a whole lot of interest wanting to see higher prices is now in play. They are participating in the marketplace. This is the evidence in price action that you have institutional sponsorship behind the move. Large flows or institutional traders have the capacity to move price, whereas we as lower grade traders in terms of retail or smaller traders in terms of in respect of a bank or a large entity in an institutional capacity, we can't move the marketplace, but they as a whole collectively can. So what we do is we wait. We're patiently watching price. we anticipate price to start to retrade back down into that down candle or bullish order blocks high. At this moment, we can set alerts. We identify the high on that candle. Now I'm using the bodies of the candles. We may end up using the wick, but I want your focus primarily on the bodies of the candles. And when we talk about wicks, I'm going to overlap order blocks with fair value gaps, because that's going to be the answer to many of your questions as it relates to when do we use the wicks and when do we use the bodies of the candles. But primarily I want you focusing on the bodies of the candles when we're talking about order blocks as a whole. So at some point when we see that level, okay, that high of that order block, when we're close to it, we can now set an alert. We can set our platform to remind us with a text to our phone, or email us, or however it is that you would be alerted by your platform. Some platforms have pretty sophisticated means of contacting you. Others is just simply an audible alarm that goes off on your computer to draw your attention to a specific market. But until then, you're going to submit to time. You're waiting. Now, this is sometimes the hardest thing to do as a trader. We identify what we're looking for in terms of an entry, but you have to wait for price to get down there. While price is trading lower, you should already formulate an idea of what it is that you're going to do in terms of risk, how much you're going to put on the trade when you buy long, and where you're aiming to get out of the market with a profit. All those things should be factored in during this time. Eventually, price will drive down into that down candle or bullish order blocks high. At that moment, if you're in front of your charts, that's when you enter the market with a long position. If you have a limit order, you're going to add a few pips, and preferably it's about 5 pips we like to add to a bullish candle. And that way the spread will be able to kick us in on a long entry. But you don't have to always rely on a limit order. You can go in right at the market as it hits that down candle. Now, sometimes it'll drive a little bit deeper into that bullish order block, and that's okay. But for now, I want you to try to key off your demo entries on the down candle's body of the candle, the high, okay, or the open in this instance. Any down candle, the body is going to begin with the opening and ends with the close. What we're actually looking at is internal range liquidity. Now, when we're trading inside the range, and that range is defined here, what we're looking for is an expansion up and to a known level of what? What's up there? Well, that's going to come in the form of external range liquidity. That external range liquidity is where we're going to be looking to offset some or all of our long position. Now, we identified the buy level. We've entered the market. Before we do this, what we should have had in mind is ideally where we're looking to take our profits. That's up here above an old high, and that's going to be in the form of buy stops. So if we're buying or entering long inside of a known range at a bullish order block at internal range liquidity, we're buying the liquidity that's offered at that level. We're going to be looking to sell our position to willing buyers in the form of those individuals that hold buy stops above that old high. That's all well and good for profit taking, but what do we do for risk? We take our attention back down to that bullish order block, because it's going to give you everything you need for your trading plan. We identify the entry at the open of the down candle. That's our buy point, or 5 pips above it. But we want to focus our attention in the midway point of that down candle. That's going to be in the form of the mean threshold. Ideally, the best order blocks will not see price trade down below the midway point of the entire body of the candle. You're going to measure the open to the close on the down candle to measure where the middle of it is. Do not use the wicks. Don't use the very high or the very low. Measure your Fibonacci level. 50% level or halfway point is the mean threshold on a bullish order block. And same thing said with a bearish order block, but you just don't want to see price drive down deeper than the mean threshold by very much. It can stab through it just by a little bit, but we primarily don't want to see it trade down there at all. The better order blocks won't do it at all. And your protective sell stop is going to be below the bullish order block's low, or below the close. Now at this point, depending upon where that low is, it could be the low of the wick, but primarily you're going to be looking at the low formed by the close of the body of that candle. Now again, focusing on what we anticipate in price, eventually price should show a responsiveness and trade up and through our old high. When that happens, you're going to be looking to take partial profits or all your profits, depending upon how big that move was and how much profitability you've obtained. What you're actually trying to do is you're going to be pairing your long exit with willing buy stops. And that is essentially bullish order block trading in a nutshell. It's been complicated by many people on the YouTube that's adopted it, and those that want to use it on Twitter and on social media, they've shared several ideas. But I want to focus on the simplicity of them here, and then we're going to graduate into more teaching later on in this month that are going to be subordinate subtopics that are going to be taught to you during the week of Christmas. So I'm going to give you actually more amplified teaching with the order blocks. So this is not the entire treaty on order blocks as it relates to buying and selling. Okay, liquidity-based bias. Okay, if the monthly chart is bearish, the weekly chart's bearish, and the daily chart's bearish, that'll give us a wonderful opportunity to get in sync with institutional order flow. Intraday charts 4 hours and less will be correcting and retracing higher. Now, again, the markets are predisposed to go lower because the monthly, the weekly, and daily, we have arrived at a bias that we have seen price want to go lower. It's been making lower lows and lower highs. Support levels are giving way. Resistance levels are being formed and being respected. When you see those evidences in price along the lines of the monthly, weekly, and daily, we can zero in on the 4 hour, okay, and start looking for liquidity on the buy side. In other words, there's going to be a premium built into the marketplace, or a rally. You're going to be looking to sell rallies. Protective buy stop raids or returns to bearish order blocks or fair value gaps and or filling of a liquidity void, each offering a potential low resistance liquidity run, shorting for a target under a recent low. What low would you be targeting? Well, you want to be primarily looking to see what's near term on the daily chart. What liquidity is resting on that daily chart that your trade on a short could be looking to take advantage of, buying back below a daily low where sell stops would be resting. If there's an objective that you can see on the weekly chart, much in the same way we would have identified something on the daily, we would be looking for that objective as well. Primarily, you're going to be trading in the direction of the monthly chart because that's where the large funds and institutional order flow is going to begin. And then it moves down into the weekly chart. Then it moves down into the daily chart. The daily chart is the most dynamic of these three time frames, and you'll see a lot more trades that actually counter long-term higher time frame institutional order flow. So that weekly chart will have a lot longer time period required to change direction versus the daily chart that can go up and down in multiple times and still maintain the bearish nature of the weekly and the monthly. And obviously the monthly takes a long time to change directions, and that's where the power of what I'm going to teach you in this module will give you. Okay, liquidity-based bias for a bullish monthly chart, bullish weekly chart, and a bullish daily chart. Intraday charts 4 hours or less will be correcting and retracing lower. This is where you anticipate the market to enter into a discount and seek sell side liquidity to buy from. And what we just shown you an example of was the bullish order block that you would use in this instance. And we're actually going to go into the dollar index and actually break it down and show you all this conceptually. Protective sell stop raids or returns to bullish order blocks or fair value gaps. and or filling of a liquidity void, each offering a potential low-risk liquidity run, buying for a target above a recent high. Just like we were referring to earlier, you're going to be aiming for something on the daily chart preferably, and you're going to be looking for buy stops above the marketplace on a daily high. It could be yesterday's high, it could be last week's high that you can see on the daily chart, it could be last month's high, it could be intra-week high. Okay, but try to find something on the daily chart to give you a trade in terms of framing your idea that you want to be a buyer, and then preferably look for something in the weekly chart that would support even higher, because if you have something higher on the weekly chart, you probably will have a lot better odds behind your trade if you're looking to move into a level on the weekly chart. And then preferably, obviously, the monthly chart, if it's bullish, you'll be in sync with the institutional order flow that would be seen by studying that time frame. So let's take a look at the monthly, weekly, and daily on the dollar index and give a conceptual idea of what I'm referring to here using bullish order blocks. So you take a look at the resistance levels you see here. We have equal highs here. Okay. And price came down and hit a level of support. You saw that happen here. Okay, so we know that there's equal highs up here. So what's above equal highs? What was taught to you in September? It's going to be in the form of buy stops. It's too clean, too neat. And price come down, cleared out an old low, but we're not going to talk about stop runs here. We're going to look at this as a support level. Okay, all we're doing is classifying this as a support. Price comes down, hits that. Okay, and we're going to wait to see if there's a willingness to trade away from it. We see it happen here. When that occurs, this up candle violates the down candle right before the level was hit at this support level. So once we have that, we now have an order block that's validated. So now we can be a buyer. If price comes back down into this candle's opening, where it starts to body the candle, that price level is 94.58. And just double check that. The opening is 94.58. Yes, correct. So when price trades back down into it, as you can see here, move over a little bit more, show more data. Price trades down into it on this candle. Now it quickly moves away from it on this candle here. But at that moment when it hits this, okay, the low on that candle comes in at 94.07. 94.07. And the level we had here is 94.58. So about 50 pips, thereabouts, in terms of movement through the level. And again, this is a monthly chart, so a little bit of flexibility is necessary. We're looking for very easy to find low resistance liquidity runs with a bullish order block. So when price hits it, this particular month is August of 2016. So we could expect to see some bullishness in August. And I'll let you see the rest of the data here. You can see clearly that the market did, in fact, trade all the way up through to equal highs here, the present time of this recording, December 2016. And we're going to take another look at this down candle here, because this order block becomes another support level. Remember, if we anticipate bullish price here, doesn't that by nature support price in the form of support and resistance ideas? So this level here, if we see a down candle off of that level, that could be a potential bullish order block as well. Remember, it's going to be trading down into that level. And why are they doing this? They're going down there to pick up more opportunities to get long at a cheaper price, more discount price. So when price was a bearish candle here, that's when the order block would have been hit again. Okay, and then what do we have here on this candle? It violates this down candle's high. Okay, and the open on that candle is, the open is 95.98, and the level is 95.98 on our level here on the segment. And you can see price hits that level here. It opens on this candle and trades all the way down, hits it. This would be another support level to anticipate seeing prices trade higher. So what we're going to do is we're going to drop down into a weekly chart, and we're going to start looking at this month here, and we're going to put a vertical line there, delineating everything to the right of this vertical line, and I'm going to highlight it big and bold so we can't miss it, and we'll just make it a big old bright red color. Okay, so now we're going to drop down into a weekly chart, and we'll see how this gives us a weekly bias as well. Here it is here. Price trades down into that level. Okay, price rallies away. When price rallies away like that, we're going to be looking for an objective to go long on this level in here, right in here. So how many times did price move away from this down candle? It's by and identified again. We're going back out to a monthly chart. That's this level here. So in May, prices validated that order block in May. Okay, so we're going to move over into May. There's May. Okay, and here's the order block level on the monthly chart. So price trades down into it here, and we wait to see, does price want to rally away? This is the level you have to be identifying because it's the monthly order block, the bullish order block on a monthly level. So we're going to broaden that one up a little bit. Okay, and then price is trading down into that. So what are we waiting for? We're waiting for evidence to support the idea that the large traders want to send price higher. Price does that here. It violates this down candle right here. Its high is broken right there. Okay, right there. So now this order block on a monthly level can be refined to this level right there. Okay, so price trades through this down candle. Now this down candle on a weekly has been refined from a monthly level. So now we can anticipate this level. If it's traded back down into it, we could be a buyer at that level. We see that happening here. Price trades down into it. Notice the down candles, midpoint or mean threshold. Right here. Just pierces it just a little bit, but does not go down below the body of the down candle. What do? We identify we're in a range. The range is this low to this high. It's trading back down into internal range liquidity, absorbing some more buys in this down candle. We should see the responsiveness on the upside. Now, mind you, this is a weekly chart. Look at the body's respect of this down candle's opening. Okay. Yes, it trades down through a little bit, but we could be a buyer at that level here with the expectation that we're going to see a run. Where at? Right above these highs. Okay, right above these highs. So now here's when bearish order blocks are not considered. This up candle, right before this down move here, we would not look to that as a selling point. We don't look at that as we're going to get short here when it trades up to that. This up candle, we don't look at that and say, okay, we're going to get short. Why? Because the higher time frame is suggesting we're going to be going higher overall, long term, in the long term trend direction. is going to drive a lot more significant price action than looking for sells. In other words, we're going to be looking to be buyers on dips and selling on the rallies to take profit. So that's when you want to avoid bearish order blocks, because you're standing in the way of the institutional order flow. So there's going to be buy stops above these highs here that we're going to sell our longs to. They're willing buyers. Great. We're going to be willing sellers if price gets up to that point from down here. In the form of pips, we have a range of almost 300 pips, 290 pips potential range there. Okay. And there's nothing wrong with that. So now also we have this level in here we can be keying off of on a daily time frame, and we can use a 4-hour time frame as well to refine that. We're going to look at this level here. Price shows a willingness to want to move away, and it does. We can now identify this level here, which was the other monthly higher bullish order block. We're going to refine that level too. Well, how are we going to refine it? Well, we have this down candle right before the price moves higher. This candle trading through the last down candle right here. That validates this down candle as a bullish order block. So we can borrow this level for a moment. Put it right on the opening. Okay, price validates the bullish order block right there. Okay, and you can see that it trades back down through it. In this instance, we didn't get that much of a move away. We want to see price move away. We want to see that. Preferably what I'm looking for is a move of whatever the order block is. Now this is a notation for your notes, okay, because this is the first time I've included this. If you see a move, here's your order block. What I like to look for is 2 to 3 heights, or the range, if you will, of the order block. I want to see at least 2 to 3 times that as a rally away, and that'll give me a nice, decent expectation to see a retracement back into to get another opportunity to buy long. We have that there. Price rallies up to this point here and then comes all the way back down into what? We have this down candle. We could have kept that there and we would have missed any new opportunity. But look what we have here. This down candle has traded into that old order block as well. So now we have a higher bullish order block right here because this candle's open is higher than this candle. So now we can refine that same level just up to a higher time frame, or not a higher time frame, but a higher order block. So now we can refine our level to that point right there. Price moves away, trades through this candle's high right here, validating this is a bullish order block. Again, we're going to be looking for a rally of 2 to 3 times the order block's body's height. So it has to trade about here, here, here. So at this point here, we have a valid swing. So now we can look for a retracement back down. This candle's opening is 95.85. The low on this candle is 95.87. So it's only 2 pips away from that. The high on this candle is 95.86. So it still was only 1 pip away from that as well. But we always add pips to our levels to get in to cover the dealing spread. We also see another higher down candle that's higher than this one. We have to move our level up to that new down candle. Every time it creates a new down candle, that's going to be the new potential bullish order block. Price trades down into it here, so there's another opportunity to be a buyer here. So that's what we do from a higher time frame to a lower time frame. We refine our entries and our levels with this in mind. Price makes a run through. Even after taking this level out here, you can take partial profits out here. Okay, take a little bit more profits out at an old weekly high here. Remember, we're looking for weekly highs to take profits at. and then leave a little bit on. And when price comes back down, we can now add back on the positions we took off here and here. Add them here as new longs. And as price rallies through to external range liquidity, which is this high here, entering at internal range liquidity at this bullish order block here, the range again, about 310 pips, just to get first profit here, okay? And then you're going to look for an expansion to continue to take out this high here and this high here for what? External range liquidity. What's going to be above these highs? Buy stops. So you're going to be looking to sell to those participants that would have an interest of buying about above these highs. Refining it further into a daily time frame, you can see all these levels get much more refined. You can see the reactions at these levels again, and now because these are weekly levels, we can see the reaction at them on a daily basis. The levels are traded back down into here, bullish order block, the weekly level that we transpose over here into a daily. We can see that this down candle, two down candles in a row. On any time frame, you have to blend them together to get one full order block. In this case, it's two down candles as one full bullish order block. So we can refine that here, use the wicks and the bodies to look for that as well, but we're going to focus primarily on the open on the candle. You see it hits it here. This is all during the election, which I personally was on the sidelines. I did not do any trading. And then recently, we had this down candle we talked about prior to this week's trading. The week ending December 16th, 2016, in a pre-market analysis, I told you to focus on this down candle prior to this big move up. I said that we would look for the mean threshold of this down candle. Why? Because I didn't think we were going to get down to this down candle. Wasn't necessary because I viewed this as a run on stops, which we'll talk about in the next teaching. But we traded right back down into the middle point of this down candle or mean threshold, and then we expected to see what happened. External range liquidity above this high, and then continue higher, reaching into the higher time frame levels we were looking for. 103, 103.50, and then 104 is next. Ultimately, 105, 107 still in the cards for dollar index long term. So you can see how dynamic, working from the monthly levels to the weekly levels, refining them, waiting for confirmation that there is a displacement by smart money, and then simply waiting for those levels to be retraded down into. And you can refine these as small as you want by going into as low as a 5-minute chart if you want the ultra really low risk entry and small stops. But you're looking for the direction from the monthly, the weekly, and the daily to get you a directional bias, and only focusing on those higher time frame directions. Those order blocks are the ones that you buy. Those order blocks also will keep you from taking focus on the bearish order blocks, because while bearish order blocks or the last up candle rate for the down moves that you see in price, those are good objectives to take profits at. Okay, if you hit a bearish order block during a time of day when profit taking should take place, guess what? You may not get that run above an old high. You may end up having to take profits at that bearish order block and then wait for Asia and Frankfurt and then London to retrace a little bit and then drive through, and then you'll see that run on a new higher high or capturing external range liquidity. So there's a lot of factors that you have to keep in mind, but this teaching was to focus your attention more on only getting on the long bullish order blocks when the monthly and the weekly and the daily show you clear indications that the market's being accumulated, and only using bearish order blocks, okay, to take profits when time of day is an impact. But if time of day is not in effect, you don't even consider the bearish order block. You might expect them to pause and consolidate there, but you're looking for them to drive price through an old high to absorb external range liquidity, because they're going to look to take profits at a higher price, not just at an old high or inside of an old high, they're going to try to build a premium in and expand that range because it's going to draw in more participation, more excitement in the form of the funds. And that's what this business is all about, drawing allocations from large institutional traders that trade managed funds and larger position holders. So with that, guys, I wish you good luck and good trade. Looking at the breaker. Okay, and what we're going to be looking at is how we can use this form of mitigation to highlight a trade setup. We're going to assume that we're watching price and it trades lower and creates a short-term low. Eventually, when that short-term low is violated and trades down into a support level, we view that initial drop down below the previous low as a potential false break or turtle soup long. Below short-term lows, there's going to be sell stops, and our expectation is we want to see if the market wants to get back above that short-term low. Initially, it may come up and flirt with that same old low and give an indication that it may want to view that as a resistance price point. We're more inclined to wait to see if it wants to show a real significant price move higher. Eventually, when we see that here, this is going to be in the form of a market structure shift. It takes out the high or the short-term high. That high is what we focus on. Wait for price to come back down into that old high. When it trades there, we view that as real support because there's going to be orders inside that high that will be looking to be mitigated. In other words, those individuals that were short at that high, they're going to want to take those positions off and maybe get in sync with a new leg higher in price. As price moves away, that confirms the breaker. And then we wait for higher objectives to be met in price action. Again, focusing on the high in between the two lower lows. One low has to be traded below, and that's going to run out to sell stops. We focus our attention on the short-term high that's in between the two lows. We use that as a resistance level that's broken that will become support, making it a bullish breaker. Contrarianly, we can look at the market in this way. When the market trades higher and takes out an old high and then breaks below the low that makes that new high, our focus is there, and we view that as a bearish breaker. Okay, so take a closer look at a bearish breaker. Okay, a bearish breaker is a bearish range or down close candle in the most recent swing low prior to an old high being violated. The buyers that buy this low and later see this same swing low violated will look to mitigate the loss. When price returns back to the swing low, this is a bearish trade setup worth considering. So we have an old high here that's traded through and rejected. It runs the stops above the old high. Those buy stops are now neutralized. And we focus our attention on the swing low that formed between the two highs. We see a market structure break, retrains back to the swing low. That is the bearish breaker. We look for another low to form with a new leg in price moving lower. The salient points are what we're looking for is an old high to be ran out or a false break above an old high. This raid on buy stops indicate buyers are trapped long. We know this is true when the market quickly does a repricing, that's seen here. Repricing lower after buy stops are taken, that is a confirmation that we are potentially seeing a new breaker forming. The low that's violated here, once market structure is broken down and all future retracements will be viewed as new selling opportunities, especially once it trades back up to the low here. That gives us our bearish breaker. Okay, for a bullish breaker, it's a bullish range or up close candle in the most recent swing high prior to an old low being violated. The sellers that sold this low and later see this same swing high violated will look to mitigate the loss. When price returns back to the swing high, this is a bullish trade setup worth considering. Again, we have an old low that's violated, taking out sell stops below that old low. Our swing high is where we're going to be looking for our bullish breaker, but we have to wait for price to break through that swing high to confirm that there has been a run on stops and that old swing high will house, or inside that swing high will reside, a bullish breaker. As price trades back down to that swing high, we would be buying that with the expectation that there's going to be a mitigation that's taking place. Those sell orders that they use to drive prices down below the old low, they would be underwater here or not making a profit. So they're going to want to take those off and add more longs. That's our bullish breaker. And then we would expect to see and anticipate a range expansion to the upside. The telltale signs that you have a breaker in formation or confirmation. The rate on sell stops indicates sellers are trapped below the old low. The range expansion that takes out the short-term high in between the two lows. This repricing higher after sell stops are taken is a confirmation that the market is, in fact, a run on stops below an old low and the old high that's violated that supports a market structure shift for bullishness. This run here supports the market structure being broken higher, and any retracements from this point on will be viewed as a new buying opportunity when it trades back into the old swing high here. When we see that, that's a bullish breaker. So let's take a look at it in real price action. Okay, we have an old low here. The market trades down below that low and punches through it again, and then rallies up. So what we're seeing here is that market structure shift after stops have been taken on the sell side. So there's been a massive repricing. So the market's going to want to look to reprice lower and retrace back down into what? Where's our focus point? We find the short-term high in the last up candle in between the two lows that most recently formed and taking out those sell stops. That's seen here. So right now, this would be viewed as a bullish breaker. We would anticipate seeing the market trade higher, where those orders would be collapsed once retraded back down to with price. Any selling orders would be mitigated and new buying orders would be replacing them. And there's the subsequent price actions you would anticipate seeing in your charts. So study your charts, look at examples where you see this formation, where you have the market creating a low and then the market trades down lower one more time and runs through the short-term high in between. This is where classic support ideas are effective. You've probably done what I've done as a new trader, where we look for support and resistance ideas by drawing a horizontal line, and you think that it's that easy. Well, you have to have a storyline behind why price is doing what it's doing. If you understand what the breaker is doing, it's indicating that it's running a stop pull of liquidity out. When you find the short-term low that's been violated, find the short-term high that this recently formed. When it trades back down to that, that will be in fact a support level that is highly probable for bullish prices. You see that here. It's trading inside the range that's created with this last up candle. Why am I using this one and not this one here? Because this one was the highest one prior to the drop down, and we're using the entire range. Price trades down into it, recapitalizes. All the selling they sold here that drove prices down to take these sell stops out, they're underwater or losing money here. They have deeper pockets than us. They'll wait for price to get back to an area where they can mitigate those shorts and add new longs, and that's why you see that explosive price action seen here. So hopefully this has been more insight to breakers, And we'll talk more about these as we go through the mentorship in futures months. Until next time, wish you good luck and good trading. We're going to be looking at an amplification of order block theory. We're specifically dealing with the mitigation block. Okay, when we look at mitigation blocks, what we're looking for is a condition in the marketplace where the market has given clear indications that it wants to break down or move higher in a step ladder formation. In other words, like selling rallies or buying declines. Buying declines in bullish markets and selling rallies in a bear market. Okay, when we look at the marketplace and we frame price action in the form of resistance levels and support levels, or anticipated bearish institutional reference points and anticipated bullish institutional reference points, we have to have a context in the marketplace behind our viewpoints. Are we looking at the market that has a bullish scenario, or are we looking for a market that has a bearish scenario? In this example, we're going to look at a market that has a bearish example. When we're looking at a market that is moving up into a potential bearish resistance level, market typically will move up and move into a old high. It could be an old low. It could be a bearish order block. It could be a breaker that we'll learn more about. It could be a multitude of things that would lead your opinion into the realm of resistance. Okay, but without going into great detail what that may be, there's multiple opportunities to frame that idea of being resistance. If a resistance level is expected, or you anticipate some selling pressure at a particular level, as is indicated here, what we do is we wait for price to indicate a confirmation that there are willing sellers up there. If the market does show a repricing and it rallies one more time up to it, what we're going to be doing is monitoring, does the market have a willingness to want to break down? And eventually the market will show signs that it does in fact want to break lower. Now if you look at this specific pattern here, this is what is referred to as an M pattern. Why? Because it looks like a giant M. Okay, well when you have this pattern here, it's a failure swing with a confirmation break in market structure. That low right here is what you're going to be utilizing to frame the context of the market structure shift. So when that shift in market structure is seen here with a break below that old low, that gives us confirmation that the market does in fact have participants on a large scale willing to drive prices lower. And that's what we need as small traders. We have to have the willingness to have the smart money indicate their cards, if you will. In other words, show their hand. Do they want to send prices lower, or do they want to send prices higher? In this case, this is indicating that the market does in fact have confirmation that it wants to go lower. So what we do is we look at this range from that short-term low up to that short-term high. Inside that range, there has been buyers. But the problem is now those buyers are underwater. This short-term rally in price highlights a specific institutional reference point known as the mitigation block. Once price posts a market structure shift lower, your attention as the trader moves to this specific low in price, right there. Inside that low, what we're going to be focusing on is the last down candle, because the last down candle is where the buying took place right before that little short-term rally up. Since price broke below that low at a subsequent later time, which is really there's no rule as to how long it takes before that low is violated. We just note it, and when it's broken, it's seen as a short-term support level that's given way with a bearish context behind it. So when we see that, we're seeing the evidence is that there are smart money entities behind the marketplace driving price lower. Now, at first glance, it looks like, well, this is a missed opportunity. But no, what we do is we focus on this low, because that last down candle will give us a bearish level to sell into. When price drives back up into that old short-term low we just referenced, there's going to be 3 reference points that you need to be aware of. The market structure shift is seen here. We're retracing back into it right there. What 3 points are used at this moment? You have point A, point B, and point C. When price action returns to the point of A reference, the long positions taken from A to B price swing will have an opportunity to liquidate or mitigate their losses that were occurred during the price move from B to C. Now this can result in new lower price swings to C for retesting, or a significantly lower price move into a support level that's under the market price. In short, this is an opportunity to sell whatever particular market or asset class this is. As the market breaks lower, let's say you look at the chart and this is what you see here. It does not mean that you've missed an opportunity. It just means that now you have a new opportunity that's unfolding. Do the longs in here, in that short-term low to that short-term high, do they need to be mitigated? We don't know for certain, but if we do have a belief that price is going to be moving lower longer term, that there's an unrealized lower support level or sell-side liquidity that has not been tapped into yet, we could be viewing this short-term rally in here as an opportunity for a new selling opportunity. We have another market structure shift. So where's our focus? Given what was explained in the previous example, where's our focus right now as a trader? Why are we looking at a specific level, and what are we anticipating? That low right there. Inside that low, the last down candle, that's what we're going to be looking for price to reach back up into. If it does that, we can be a seller at that moment. As price drives back above it, into that low, we're watching price trade into that last down candle right before it had that short-term rally before. Right at that moment here, we're looking to go short. As price hits that last down candle in the previous short-term low. Where's your focus at this moment? We're anticipating price to move down from this point here, which is giving us a short opportunity to run the liquidity out below this short-term low here, and potentially as low as our higher time frame support level. As price hits our longer-term support level, or anticipated bullish institutional reference point, which could be an old high, it could be an old low, it could be a bullish order block, many opportunities to frame that idea, but whatever that is that forms your idea for support, this is the objective that you'd be reaching for. As price hits that level, we would be collapsing our trade and moving to the sidelines waiting for new developments. When we have this, in the marketplace, what we're seeing is the classic support broken turns resistance. Every time price moves back to an old low, actually happening is it's referred to as buyer's remorse. The buyers at the previous short-term low that saw a short-term pop in their favor, then eventually saw the market break below that low they bought at. When price gets back to that level, they're remorseful for buying it, so they bail. But on an institutional level, the smart money understands these short-term fluctuations, and they can drive price on a short-term basis higher or lower through manipulation. So if they're going to manipulate price on the short term by having large orders come in and push and bully market pricing around, they're going to want to liquidate those positions because just like anyone else, they don't want to incur losses. So this gives them the opportunity to mitigate those losses. Premium price highs are bought by less informed traders and sold by smart money. Which are you going to be grouped in? Okay, folks, we're going to look at a quick example. And I'm going to draw your attention to a liquidity void in here. And there's equilibrium of that liquidity void, body to body end, or is the open and close. And we're going to highlight that reference point here, so halfway point of this equilibrium. The idea is we broke this high back here. We're expecting continuation on the upside. Market trades higher, but it shows a breakdown in here. Okay. In here, this failure swing right there, we're going to be looking at this low. And I'm just going to draw horizontal lines in on the respective lows. And this will be a new mitigation block when we drop down into the lower time frames. Market should sell off there. It sells off, breaks this low here, so the last down candle on this move here is there. So once price trades back up, that's a sell right in here. It shoots it, just overshoots it by a little bit, but nonetheless it breaks lower right here. So now our attention is on this low. Every rally that sees lower prices needs to be mitigated right here. So if we trade back up to that low, that's a sell. Right there is a sell. We're going to be aiming for a move back below this low, ultimately down into our equilibrium of our liquidity void right here. Low comes in at 111.48, 111.48. Here's a short-term low, hits it, trades lower, trades back up into the last down candle, hits it, overshoots a little bit, but it's inside the body of the candle, which is what a mitigation block represents. Price trades down below the last down candle here, and we have another lower low here, so we can adjust that one to that low there, right there. Price hits that. Objective is going to be break below this low, sells off, goes through it, and ultimately goes down into our mean threshold of the liquidity void. So a couple different things shown in here as an overlap study on mitigation. Let's take a look at a 30-minute chart on the same price action. Here's a mean threshold of the liquidity void. Last down candle, wait for the up move. Price hits it, sell it right there. This is a mitigation block. Everything that was used to drive price higher, once it's traded below here, it's underwater. They're going to want to mitigate those losses at that candle, sell short. This last down candle here is violated here. If price trades back up to it here, we can be a seller. The body's the whole entire candle is used, not just the bottom, but we can be a seller down here. So it could be a short seller at 112.62, and our stop has to be somewhere above the down candle in here. Okay, so that high on this candle comes in at 112.89, so it needs to be above that in the form of a stop. So we could be seeing just a little bit of drawdown in here, about 20 pips or so, but never getting much above this down candle. Price trades lower, violates a very convincing break down here. Last down candle, the low, trades up. Now again, notice the body of the candle is not violated. This is hallmark characteristics of a mitigation block. Price trades up into it. We're expecting prices below this low now, and then ultimately reaches down into our mean threshold of the liquidity void. Then ultimately, I'll give you a view of what took place. Price eventually started to move back up. So hopefully this has helped you with mitigation blocks. We will still talk more about it again in the PDF file for your December 2016 ICT mentorship study notes. Until next time, I wish you good luck and good trading. Okay folks, welcome back This is teaching 3.3, dealing specifically with rejection blocks. Okay, let me ask you a question real quick. What do you see in this chart at major highs and lows? Now, take a moment, pause the video here. Okay, you may have noticed these old highs being violated and a significant movement away from that. And we understand this as a turtle soup or a false breakout. It's important to understand that it's probably easy for you to see these in hindsight when I pick them out on the chart, but you probably don't have that much experience seeing them come to fruition beforehand. So in other words, you don't see them forming in advance. And it's because you haven't spent enough time going through the charts, seeing how they form over and over and over again. Now, obviously, you may not have noticed these. I'm pointing them out to you here. But for some of you that have been working with my content, maybe you've seen other ones. But these two here are the two majors. Okay, so you have two major false breaks above an old high, a nice false swing above a previous high, and then a rejection and a subsequent significant price swing lower. And then we have a false break below an old low, and we have a nice significant price rally higher. But let's take a closer look now. We have a old low here that's been violated. So the sell stops below that low has been ran out. So we would expect repricing on the upside, looking for buy side liquidity. The market trades above an old short-term high here, pairing up the buys from the previous low with buy stops they can sell to with a movement above a previous high. Each one of these is a turtle soup, the first being a turtle soup long, the second being a turtle soup sell. Down here we have an old low that's violated where sell stops have been ran out. We have an old low over here where sell stops have been ran out. We have an old high here where buy stops have been ran out. So you can see significant price swings at looking at the daily chart like this, and it gives you a great deal of prognostication when you anticipate every time a new high or low is formed, we expect some measure of rejection. That's the first anticipatory price skill set that you should be working towards developing, because it's the hardest one to groom in your trade psychology. Some of you probably understand that higher high failure swing and lower low failure swing, or turtle soup long and turtle soup buy. Some of you probably aren't aware that there are other distribution and accumulation patterns that take place at highs and lows. So let's take a look at that now. Okay, we're going to look at a bearish run on buy side liquidity, or a turtle soup sell. Now, obviously, when you look at this price action here, it should be pretty obvious after studying my material. We have equal highs that's been ran out. So there's buy stops above those equal highs in there have been ran out here. We would reasonably expect to see what form? A sweep through and a potential rejection and trade lower. And that's what you would see here as an example. Now, some of you probably can see this relatively easy in the chart formations and how a previous high or a previous low has been violated, and then a subsequent rejection and a retracement of a longer magnitude. But I want to teach you tonight a different approach to looking at distribution and accumulation. Okay, look at this pattern here. Okay, we're going to talk about a bearish rejection block. And before we get into it, the ideal setups are found in major to intermediate term downtrends, and the bearish rejection block is when a price high has formed with long wicks on the high or highs. It can be more than one candle that forms a high of the candlestick or sticks, and price reaches up above the body of the candle or candles to run the buy side liquidity out before the price declines. As you can see, there are several wicks here forming potential resistance. Now, a classic chartist would look at this as a potential continuation pattern in the form of a bull flag. We taught earlier in this mentorship the falsehoods that come along with some of the classical chart patterns. Price does not move around because of animal patterns or supposed geometry in price action. It's based on the orders. Okay, and looking at this price action here, if this is near a overall longer term resistance level or trading into a bearish order block or an old low that may not be seen in this sample size of data, but you can see prices ran up higher for a good number of candles. Then it starts moving into a small consolidation. But more importantly, I want you to look real close. Is there a strong likelihood that this is going to go higher based on a continuation pattern of like a bull flag or a pennant? Or is it showing underlying distribution? Notice there's no higher high here. Or is there? Take notice of the highest body in this formation and the most recent candle that traded through it. Price pushes above the previous highest candle's body. Seen right here, that run above the highest body's candle produces the distribution seen in the chart here. Price does not need to make a higher high to have a failure swing. By looking at the bodies of the candle, which is one of the first things I taught when I started teaching online how the foreign exchange market operates, you don't need to have a great deal of understanding about candlesticks except for understanding where the open, high, low, and close is. And if you follow every swing high and low, and you chart the open, high, low, and close, and you deal specifically with the opens and closes, you'll be able to ferret out what distribution and accumulation takes place at these turning points. As you can see, the real pattern here is from this previous highest bodied candle, then the subsequent later higher drive higher. This candle here, prior to this candle moving up, this candle was the highest bodied candle. We're not paying so much attention to the wick. The wicks highlight the idea of this pattern forming. This pattern here, shooting above this previous body or previous close, this is the highest close or highest open in this swing high. This candle here drives above it, clearing out the buy side liquidity and then rejection. Basically, what we're seeing is distribution. So what is it really to see a rejection block, and what does it look like? I have a crude depiction here with a single wicked candle. Now this is going to be better understood when there is multiple candles that form the high and multiple wicks. You're still looking at the highest close or high. You're still looking for the highest open or close inside the swing high that forms. The wicks are just drawing your attention to a potential rejection block. When you see the wick, you have to build the parameters for the rejection block by finding the highest high and the highest open or close in the swing high. It does not matter if the highest candle is a bearish or bullish closed candle. You're still looking for the highest high with the highest open or closing price into the highest wick. That frames the rejection block. So once we have the rejection block defined by the highest wicks high and the highest open or close in the swing high, that frames the rejection block. And in your mind, you should be viewing it like we have here, a candle all in of itself. This range is going to be a selling block. In other words, we treat this as a bearish order block. When price trades back up to the low of that range, that is your trigger. Now you can do one of two things. One, if you're aggressive, you can sell at that price and put a significant stop loss above that particular price level. Or you can wait for it to trade through it a little bit, and I'll leave that up to you in terms of all the additional insights that we'll be sharing over the mentorship about entry patterns. Or you can wait for it to trade above that level, and if it moves a significant amount above that highest open or close, in this case it's the highest close of that bullish green candle, if it trades above that particular level and it does not trade to a higher wick high, you could be a seller on a stop below that level. So that way you can be selling on weakness. This is one of the few times I use selling on a stop as an entry pattern. What it looks like in the charts, here's one example here. We have a candle with a wick. We use the highest body reference point being open or close. In this case, it's going to be the open. And price trades above it just a little bit, violates that, doesn't make a new higher high, and it makes a run eventually for the sell side liquidity below the marketplace there. So rejection block for the bullish side of the marketplace is obviously in ideal scenarios, it's in major to intermediate term uptrends. And a bullish rejection block is when a price low has formed with a long wick or wicks. It could be formed over multiple candles. And the low or lows of the candlestick or candlesticks, again, it's not limited to just one candle. And price reaches down below the body of the candle to run the sell side liquidity out before price rallies higher. Again, we frame the rejection order block, in this case the bullish rejection order block. It's going to be the lowest wick low and the lowest open or the lowest close that makes that swing low on the time frame you're looking for the pattern. Once you identify that, you have framed the bullish rejection block, and we treat this as like a bullish order block. When price trades back down into the high of the block, we can be a buyer just below it, or we can wait for price to trade through it. If it's a little bit longer term time frame, we can wait for it to trade through it by a little bit, and then we can be a buyer on a stop just above that particular level here. Again, the trigger is that high or the lowest open or the lowest close in that swing low. But the key is it has to be a swing low that has a wick or wicks. In price action, this is what it looks like. Price makes a previous low with wicks. Market comes down, trades down just below the bodies of the candle. And then we see a strong rejection because of a massive accumulation that comes in. It's not always required to see a higher high for a failure swing, which would be a turtle soup sell, or requiring always a lower low for a rejection for a turtle soup long. We can anticipate levels like this to be taking profits at, if we're short in this case. If the market had been trading in our favor on another type of setup, we could look at the take profit objectives to be covering the short just below the lowest open or close in the previous swing low. Don't always demand that price gets below the wicks. It's really the bodies of the candle that the closest thing to institutional understanding you're going to get when you're using retail price delivery mechanisms like the platforms we have to trade through from a retail perspective. Hopefully this has been insightful. We're going to have a lot more information as we go along and we start talking about specific entry techniques. We'll be revisiting all these things as well and amplifying them. But I want you to go through your charts and look for examples of rejection blocks in their subsequent price moves after their formation. Until next time, wish you good luck and good. Okay, folks, welcome back. And we're going to be continuing our discussion on reinforcing order block theory. This teaching, we're going to talk about propulsion blocks. And a propulsion block is a candle or bar that is previously traded down into a down candle or bullish order block. and takes over the role of price support for higher price movement. In this example here, okay, in this crude diagram, we have a down candle, which shows price willingness to move higher. And then we have a new down close candle that trades right back into it, seen here. That candle becomes a propulsion candle. What makes it propulsion is that it's already dropped back down into an order block that's already predisposed to go higher. Then we created another higher order block that touches the initial one. That new higher level bullish order block or down close candle will be highly sensitive. It should never see the mean threshold break half of the body's height or the middle of the range of that candle's body. That mean threshold should not give way. The sensitivity is going to be very much more amplified when it trades back down into the high, but we are willing to allow it to still trade down in the middle of the range or mean threshold, but it most likely it will never do that. It just trades down into the high of the candle and it immediately explodes. It may go pip or two below the high of that particular down candle, which we're naming as a propulsion block. The market will show a sudden and violent movement away from that down candle. That's a propulsion candle. Let's take a look at it in price action to get a better feel for what it looks like. Okay, first let's take a look at a bullish propulsion candle. Okay, you can see price has moved from a low here, and we're on the buy side of the curve, and the market has several down candles in here. So we would take this as one full bearish candle because it's consecutively 3 down candles. So the bullish order block is framed like this. So we have equilibrium down here. Price trades all the way down to this level here, but falls short of equilibrium. So we have a level at which price could reasonably trade down into, but it doesn't do it here. So price trades lower here and then rallies through its own 3 consecutive down candles. So this is an order block as well, together, all 3 candles. And then we have this candle right here. Okay, see this down candle? It's trading into these down candles together. So this is all one bullish order block because it's all down price movement, reaching for a level to buy, and then price moves through. This candle here trades through the highest of the down candles. So that confirms this is a bullish order block. The very next candle trades higher, and the next candle opens and trades down into this candle here. When this candle creates the down close and closes, this becomes a propulsion candle. What makes it a propulsion candle is that we are trading another down candle into a previous down candle when the underlying context is bullish. The powerful nature to a propulsion candle is you don't ever really see a mean threshold violation on it. So if you get an opportunity to see it trade back down into, as it does here, this candle opens, trades down into it right there. The open comes in at 133.45. The low on this candle comes in at 133.45. Goes right to that candle. So that's a bullish entry here with a propulsion candle. And again, all it is a down closed candle that trades down into a previous down closed candle, or in this case, this is a 15-minute time frame. I don't have a way of showing you a 45-minute chart here, but it's the same price action that we've seen here. The down candle trades into this order block that would be bullish, and then we see price trade higher and then come right back down into this candle here. This is the propulsion candle. That means we should see immediate responsiveness on bullish price movement higher off this down candle should it trade back down into it again. Here's the clue. If we break the mean threshold of that type of candle where it's already traded down into a previous order block, it's bullish. If this loses its mean threshold, chances are it's probably not a good trade. So that means you can have a really ultra tight stop loss on your long entry, or you can have immediate feedback that you're on the wrong side of the marketplace and you probably are better off either going to the sidelines or many times looking for a reversal to go short. Okay, we're going to look at an example of a bearish propulsion candle. Okay, we're going to frame it around a higher bearish order block. It's this candle right here. Price trades up into it here, breaks down. So now we're going to add another level of order block theory. So we have this last up candle that's the bearish order block here, referencing this one as well. So now watch what happens. We have price movement lower, then we trade right back to this order block right here. This candle becomes the propulsion candle right there, this one. So now we can cut that candle in half right here. Boom, hits it right there, main threshold, trades immediately lower. This is a sell entry on the propulsion candle that's bearish. We could be a seller there, and we can also use a entry at a later time where it trades right back into this candle's low, where it trades right here, hits it, responsiveness immediately moves lower. So look at the responsiveness after it trades into this candle. You have to see it break below this candle's low, which it does here. Okay, it's already showing a willingness to not want to go above that mean threshold here. But it breaks down, then trades right back up into this candle's low. It doesn't need to go up to the body. It's the low of the candle on the propulsion candle. It's going to be very, very sensitive. Hits it, immediate, quick responsiveness as you would expect. That's why I gave you the name, the propulsion candle, because it propels price quickly and suddenly, and it gives you immediate feedback. Very little drawdown, immediate price responsiveness. That's exactly what we're looking for as short-term traders. So hopefully this has been insightful to you guys. We're going to give more information as we go along in the months, and when we start mapping out outlines and setups, we'll see exactly when to anticipate propulsion candles. Until next time, I wish you good luck and good trading. Okay folks, welcome back. We're looking at teaching 3.6, reinforcing order block theory. We're dealing specifically with the vacuum block. Okay, a bullish vacuum block is a gap that's created in price action as a result of a volatility event. The gap forms by a vacuum of liquidity directly related to an event. Non-farm payroll can create a vacuum block, or in futures, a session open can. Okay, on the left-hand side here, we have a crude depiction of price action. Short-term lows formed, and this could be if we're trading futures contracts where they have session opens and closes where there's no trading, or if we see a stock, it could be a intraday indice, it could be like S&P 500, or it could be just any old Forex pair, and there may be a large volatility injection coming in the form of a economic calendar release. It could be non-farm payroll. It could be a FOMC related event, anything along the lines of interest rates, or it could be a geopolitical event that was not foreseen, maybe not even on the economic calendar, say a terrorist attack, something of that nature. At any rate, we're going to assume that we see the market gap up. Okay, when we see that gap, the first assumption is on the part of most traders is things going to keep going higher right away, and sometimes it will. But we're going to be looking at the vacuum block in the scope that we can use it to get in sync with what may be underlying in the marketplace. The short-term low that's formed here in our diagram, if we have traded lower prior to that swing low, in this case, this outline that I'm giving you here would be a little bit more probable. If the market had been rallying for a number of days or weeks, or it's been in a prolonged uptrend, and then it does this, this could potentially be an exhaustion gap. And an exhaustion gap is typically a graphic depiction of capitulation. And capitulation is basically like the last bit of momentum in an underlying trend or direction. But assuming that we have been in a down upward correction in an upward market, or if we've been in a down market and we expect the market to give some kind of a bullish news, or we're expecting the market to reach for liquidity above where we're currently trading at, and the news event releases and we get this gap up. What we're essentially saying is if we gap up away from a market that's in a discount, we've had some retracement, but we are expecting higher prices nonetheless. If we see this gap like this, the first thing I want you to start thinking about is when we see that space in between the two candles is important. Now, while on our charts there's going to be a vacuum, if you will, of trading, there's no trades being made between the previous candle's close and the next candle's opening. So that gap, it could be large, and sometimes, for instance, non-farm payroll, it can gap sometimes 30, 50, 60 pips, from where it was trading right before the numbers release, and then all of a sudden they do a quick repricing at the central bank level. Because that happens, there's absolutely no way for any trader to execute. There's no trades between those two price points. So what it does, it creates a vacuum of liquidity. Most times, I'm not going to give you a specific percentage because there's no real accurate way of depicting that, because it's just, we're going to classify it as a high probability that the market will want to come back and try to close that in. There's some points that I want you to take special notice of as we go through this, but for the most part is we're going to anticipate that move to fill in. But first we have to identify that gap in a specific manner, because after looking at the gap we come to the realization again that there's no trades being made in this range. So if there's no trades in that range, what's the market actually done? It's gapped up through it and started trading at a higher price on a new candle when it opened up, and it traded a little bit more, and now we have to discern whether or not the market is going to continue and run away from that price level and leave the gap opening, or will it trade back down and close in that range. And if it doesn't close in the range, how much can we reasonably expect for that range to close in, and still look for a potential buy setup. Inside that range we have a vacuum block, and that means we've blocked out a reference point in time, and we have to look at it like this, because even though there's no candlestick or bar on our chart, price did in fact have a parameter before and end. We can look at it as this candle or range, okay, and again we're interpreting it, we're visualizing it, if you will. There's an absence of liquidity there. There's an absence of price being traded there, but we're defining it as the high and the low of the gap. Now, if we looked at it in the terms of a candle or a bar, it would be just the same as anything else. We would expect to see a mean threshold, an opening, and a close. So if we see that, okay, we're just going to treat it just like any other candle. So let's take a look at it now with the gap in mind, and let's assume for a moment we start seeing price trading lower. Our expectations are one of two scenarios. If we're bullish, we're looking for, is there any bullish order block or down candle that would cause the gap to not want to fill entirely? As price trades down, we see that actually occurring here. We have the down candle right before the up move, and it's two consecutive down candles, so the bullish order block would begin at the higher of the two down candles prior to the gap up. And as price trades into that candle, we would reasonably expect a potential bounce there and leave that little gap opening still intact, but this could potentially be a buy. Now, if you're looking for this to occur, you'd have to see immediate feedback. And if you're going to be buying there, can you take the risk that's associated with entering here and using a stop below that lowest down candle? So your range in terms of managing your risk and defining the risk would be between those two reference points. If price was trading lower, and we get down to that order block area, and we don't want to buy there. Say we have a little bit stronger conviction that we'll probably trade back down into the last up candle before the gap. The reasons I would expect to see that is if it was time of day sensitive. In other words, if we had a lot of day left in the day where we can trade. In other words, if it's just now beginning of New York would probably come down and close that gap in. If it was gapped up late in the afternoon, chances are it probably would leave the gap open. But if price trades down into this point here and time of day permits more trading, in other words, if it's still an early New York session or maybe even a London session that it creates that gap, highly unlikely that it does it in London. Usually it's a trading event that takes place, but a gap like this usually occurs in the New York session or late New York with FOMC. But generally at 8:30 news embargo lifts, there is usually markets that cause a gap like this to occur. So we're going to assume that it's still early in New York. 8:30 would be relatively decent in terms of allowing more time for the day to unfold. We could forget the bullish order block level here and anticipate this small little area still to form. But if we are later in, for instance, say it's the 10 o'clock or 11 o'clock hour, and we get this gap, we may end up seeing this portion of the gap to remain open, and that would present us a fair value gap for a later time. We would look for price to at a later time come back and close that in, but leave it open during this specific trading day. Again, that would be our thought process like that if the gap occurs late New York opening or after 10 o'clock in the morning to 11 o'clock in the morning, the news events that usually release there. So we have two reference points here, the opening of the gapped up candle and the close of the up candle right before the gap forms. And again, as price trades lower, boom, it hits that, and we would see a complete closure of the gap. That would be a full return on a vacuum block. In other words, everything has completely been closed in. This whole range here is 100% filled. This is in effect perfect delivery of price. Once it's done this is completely balanced out now. And if we are expecting higher prices, if there's liquidity that hasn't been sought out after prior to that highest high that formed on the gap opening, that bullish liquidity above the marketplace would now allow price to drive higher. So this could be a buy here. And now notice buying here and using a stop loss below the lowest low, your risk is more defined for more leverage, but still having the same potential parameters for exposure percentage of your equity. If price was to trade down and hit that level, and we start to see a rally up, we don't want to see price ever come back down below the level that would have caused it to close the gap. When we see this, we're looking for the up candle that formed at the gap. We want to see that low be cleanly broke through. We don't want to see it hesitate here, because otherwise that would be a bearish order block, right? So what we're looking for is we're anticipating the bullishness of this move to drive right on through that last up candle when it gapped up, because now price has already been delivered efficiently. That vacuum of liquidity has been completely balanced out. We traded down with the two down candles that closed the gap. Now we've had a bullish move up. So what has happened? Price has been delivered on the downside to close the gap, and now it's trading up. There's no reason for price to come back down. It's closed in and filled in that vacuum of liquidity. There's no reason for it to come back down and trade below the last point of reference before the gap, which would be the close of the first up candle. So when that closes in that range, the vacuum block is completely filled in, and now price is permitted to trade bullishly higher. And once it takes out that high, we would usually expect to see price continue on the upside. So in summary, a vacuum block is nothing more than a breakaway gap. What I teach with the breakaway gap is, because it creates a vacuum of liquidity, you have to understand not all gaps fill completely. And why do we anticipate the gap sometimes not filling? If there's a bullish order block, in this case, if we're bullish and we gapped up, the price may only come down to a bullish order block that would be inside that gap. and price just comes to that level and then stops trading lower and then rallies higher, leaving a small gap, which would be classified as a fair value gap. And we could use that at a future time when price is now trading lower, and we would look for price to come down and close that gap in. But if it stays open, we would label that while we're bullish as a breakaway gap, and it would show willingness and strength to get in there and expect higher prices. So if we're expecting bullish prices and price closes in that gap, it's filled in that vacuum of liquidity. It gaps up, we close in the gap with price delivery on the downside. Price trades bullishly up through it, so now we've had both passes in price and delivery. We've had it sell down and rally up. So there's been no reason after that point to see price go down below that first up candle's close. If it does, the trade is probably going to be suspect, and you would want to look to take some profits. If you've seen a move like this, take something off, but if it starts to correct and go lower, you want to take the complete trade off because there's no reason for it to come back down into that area once it's already closed the gap. So then this is a bullish vacuum block. The reverse would be seen if we had gapped lower, and we would wait for that gap to fill in on some up candles, and then we would go short in the same menu that we would do here, looking for longs just in reverse. Welcome back, folks. This is teaching 3.4 of 8 of December 2016 ICT mentorships content. We're dealing specifically with the reinforcing order block theory and reclaimed blocks. Okay, we're going to be looking at the market maker buy model first. And what this essentially is when the market drops down and has a price swing lower, reaching into a higher time frame or intermediate term support level. And that support level can come in the way of an old high, it can come in the way of an old low. It could be a bullish order block, it could be a filled void or closing in on a fair value gap. Any one of those things could lend well to a price support level. But the idea is we're going to be anticipating that market move lower, and you can anticipate it and watch it go lower and be short, or if you look at it and the move has already transpired, if you notice you have seen the decline down into a support level, we can start looking at specific levels to watch for reclaimed order blocks. First, we have to understand the sell side of the curve on a market maker buy model. That's the drop down into that support level before we see the move higher. The market makers are going to be scaling in early, so they're going to have areas at which they start buying early because their positions are much larger than us as a retail trader. They require a great deal of movement and time to price in their orders because they can't facilitate their entire order on one transaction, one specific move from a level. They have to scale that position in, and that's in the form of hedging. As the price drops down into the lower level support, they're going to be building in more positions, and you'll see as you watch price go lower and lower, there'll be small little transactions that cause the market to create short-term little lows in the market. So as the market moves lower, every time we see a small little bounce in price action, that is a minor displacement showing that there was new accumulation being taken into the marketplace. In other words, the smart money is actually accumulating new long positions. You have to have the understanding that that lower level support that it's reaching for is going to be the ultimate price level it's most likely going to have its impulse price swing away from. Prior to that low being formed, like I said, there's going to be initial short-term rallies that take place. Many times traders that are looking at those as entry points, they end up getting stopped out because what they're doing is they're piggybacking on an entry that is based on a hedging motive on the market maker. So as the lows keep creating lower lows, but every time the price makes a small little short-term move higher, we're going to be referencing that last down candle because that's a bullish order block. But it's occurring, we're watching the bullish order blocks or the down candles right before a small little price movement higher during the sell side of the curve. Now the market maker buy model, the curve is basically a price swing lower that trades higher. That's all market maker buy profile is, or market maker buy model. It's just understanding that the market's going lower to go higher. Eventually, we'll see the price move higher off of a major support level, and we'll start seeing the buy side of the curve come underway. The market will start pricing new higher highs, and as it does, we're going to be focusing on those old down candles during the sell side of the curve. Every time there was a bullish order block that was created on the major price swing going lower, and it saw a little bit of a minor movement higher, that has indicated that there was hedging going on, and that down candle is what we're going to be looking to reclaim or watch price recapitalize that old order block now that we're on the buy side of the curve. Every new buying opportunity is going to be matched up to the previous down candle while the price was dropping earlier on the sell side of the curve. And ultimately, everything will match up with the down candles on both sides of the market maker buy model. So what is a bullish reclaimed block? It's a candle or bar that was previously used to buy price, and a short-term bounce confirms minor displacement. In the buy side of the curve, these old blocks or down candles will be reclaimed for new longs. So let's take a look at what it looks like in price action. Okay, we see the market dropping down from November 24th into November 29th. Okay, so we have a market maker buy model where the market's going down to go higher. See here this down candle on the buy side of the curve right here. This down candle right before this movement up here, this displacement shows that this was an actual hedging where they were buying early and the market drops lower. Okay, once it makes its low here, you can see the price did in fact come back down to this same down candle right to it here and was reclaimed, or they recapitalized this old order block here and price started to move higher. The next level is here, this movement down prior to this displacement here. All of this movement here, this down candle, is a bullish order block. On the right side of this low, now we're on the buy side of the curve, and that's what this movement is here. It hits it right to the pip, and then price moves higher. So they are two examples of reclaimed bullish order blocks. Okay, now we're going to take a look at the market maker sell model. This is just the same thing, just in reverse, where we're anticipating the market to trade higher to go lower. You may not see it happen before the fact. You may notice that the market's making a high and you expect to see a sell-off. So we can use this information just by focusing on the buy side of the curve. Every up candle that sees a displacement or a short-term decline confirms that there are hedging underway. That means that they're selling short early and market makers are selling into these rallies. When we get to the sell side of the curve, every single time we see the market trade back up into a up candle or bullish candle right before the down move during the buy side of the curve, that bearish order block is going to be reclaimed. And you can take that as a new short. And again, matching up during the buy side of the curve while price is being built up into a premium, the market makers are actually going to hedge into that rally, selling short. They have deeper pockets than us. They can do this for a longer period of time. And as they do this, they're pricing in more short positions. We can match that up and see it like X-ray vision into price action by looking at every single up candle that has a small displacement or short-term decline that's confirming that there was hedging underway. Again, we understand that market makers and smart money, they're the only ones that can move price around. So if there is a displacement in price and we see bearishness after an up candle, we can assume that this is going to be evidence that they have been hedging and selling short early. When we get to the high and we climax there and start trading softer and going lower, every time we retrade back up into that old previous up candle during the buy side, but we're to the right of the high that's already formed, we can now take new shorts at these old bearish order blocks. Everything matching on the buy side of the curve to the sell side of the curve. So again, in summary, a bearish reclaimed order block is a candle or bar that was previously used to sell price, and a short-term decline confirms minor displacement. In the sell side of the curve, these old blocks will be reclaimed shorts or new entries for short positions. All right, let's take a look at this chart. We'll take a look at the example of a market maker sell profile. And using the reclaimed order block, we're going to be looking at the sell side of the curve, or to the right of the high. And we're going to be focusing on every up candle that showed a willingness to see price drop during the buy side of the curve, or to the left of the high that formed. You see here, the last beefy candle right before this drop down. Price trades up into it here and sells off. The next example is this up candle here, which would be a bearish order block. Would be reasonably seen as, in the free tutorials, you would think that this was probably a bearish indication to start looking for lower prices. It doesn't do that here, it trades through it. But we see a climax high, so now we see price doing what? It trades up into this up candle. This is a new short. Another example here, this last up candle here, price trades up into it here, very handsomely sees that as a displacement lower here, so you started hedging here. This is a selling short opportunity to see the completion of the market maker sell profile. So again, in summary, we use the market maker buy and sell models to be able to match up old order blocks during the buy side and the sell side of the curve, and we wait for that reclaimed mechanism that takes place where the market makers will use these same reference points and facilitate new positions. We're going to be looking at an amplification of order block theory. We're specifically dealing with the mitigation block. Okay, when we look at mitigation blocks, what we're looking for is a condition in the marketplace where the market has given clear indications that it wants to break down or move higher in a step ladder formation. In other words, like selling rallies or buying declines. Buying declines in bullish markets and selling rallies in a bear market. Okay, when we look at the marketplace and we frame price action in the form of resistance levels and support levels, or anticipated bearish institutional reference points and anticipated bullish institutional reference points, we have to have a context in the marketplace behind our viewpoints. Are we looking at the market that has a bullish scenario, or are we looking for a market that has a bearish scenario? In this example, we're going to look at a market that has a bearish example. When we're looking at a market that is moving up into a potential bearish resistance level, market typically will move up and move into a old high. It could be an old low. It could be a bearish order block. It could be a breaker that we'll learn more about. It could be a multitude of things that would lead your opinion into the realm of resistance. Okay, but without going into great detail what that may be, there's multiple opportunities to frame that idea of being resistance. If a resistance level is expected, or you anticipate some selling pressure at a particular level, as is indicated here, what we do is we wait for price to indicate a confirmation that there are willing sellers up there. If the market does show a repricing and it rallies one more time up to it, what we're going to be doing is monitoring, does the market have a willingness to want to break down? And eventually the market will show signs that it does in fact want to break lower. Now, if you look at this specific pattern here, this is what is referred to as an M pattern. Why? Because it looks like a giant M. Okay, well, when you have this pattern here, it's a failure swing with a confirmation break in market structure. That low right here is what you're going to be utilizing to frame the context of a market structure shift. So when that shift in market structure is seen here with a break below that old low, that gives us confirmation that the market does in fact have participants on a large scale willing to drive prices lower. And that's what we need as small traders. We have to have the willingness to have the smart money indicate their cards, if you will. In other words, show their hand. Do they want to send prices lower or do they want to send prices higher? In this case, this is indicating that the market does in fact have confirmation that it wants to go lower. So what we do is we look at this range from that short-term low up to that short-term high. Inside that range, there has been buyers. But the problem is now those buyers are underwater. This short-term rally in price highlights a specific institutional reference point known as the mitigation block. Once price posts a market structure shift lower, your attention as the trader moves to this specific low in price, right there. Inside that low, what we're going to be focusing on is the last down candle, because the last down candle is where the buying took place right before that little short-term rally up. Since price broke below that low at a subsequent later time, which is really there's no rule as to how long it takes before that low is violated. We just note it, and when it's broken, it's seen as a short-term support level that's given way with a bearish context behind it. So when we see that, we're seeing the evidence is that there are smart money entities behind the marketplace driving price lower. Now, at first glance, it looks like, well, this is a missed opportunity. But no, what we do is we focus on this low because that last down candle will give us a bearish level to sell into. When price drives back up into that old short-term low we just referenced, there's going to be 3 reference points that you need to be aware of. The market structure shift is seen here. We're retracing back into it right there. What 3 points are used at this moment? You have point A, point B, and point C. When price action returns to the point of A reference, the long positions taken from A to B price swing will have an opportunity to liquidate or mitigate their losses that were occurred during the price move from B to C. Now this can result in new lower price swings to C for retesting, or a significantly lower price move into a support level that's under the market price. In short, this is an opportunity to sell whatever particular market or asset class this is. As the market breaks lower, let's say you look at the chart and this is what you see here. It does not mean that you've missed an opportunity. It just means that now you have a new opportunity that's unfolding. Do the longs in here, in that short-term low to that short-term high, do they need to be mitigated? We don't know for certain, but if we do have a belief that price is going to be moving lower longer term, that there's an unrealized lower support level or sell-side liquidity that has not been tapped into yet, we could be viewing this short-term rally in here as an opportunity for a new selling opportunity. We have another market structure shift. So where's our focus? Given what was explained in the previous example, where's our focus right now as a trader? Why are we looking at a specific level, and what are we anticipating? That low right there. Inside that low, the last down candle, that's what we're going to be looking for price to reach back up into. If it does that, we can be a seller at that moment. As price drives back above it, into that low, we're watching price trade into that last down candle right before it had that short-term rally before. Right at that moment here, we're looking to go short. As price hits that last down candle in the previous short-term low. Where's your focus at this moment? We're anticipating price to move down from this point here, which is giving us a short opportunity to run the liquidity out below this short-term low here, and potentially as low as our higher time frame support level. As price hits our longer term support level or anticipated bullish institutional reference point, which could be an old high, it could be an old low, it could be a bullish order block, many opportunities to frame that idea, but whatever that is that forms your idea for support, this is the objective that you'd be reaching for. As price hits that level, we would be collapsing our trade and moving to the sidelines waiting for new developments. When we have this in the marketplace, what we're seeing is the classic support broken turns resistance. Every time price moves back to an old low, actually happening is it's referred to as buyer's remorse. The buyers at the previous short-term low that saw a short-term pop in their favor, then eventually saw the market break below that low they bought at. When price gets back to that level, they're remorseful for buying it, so they bail. But on an institutional level, the smart money understands these short-term fluctuations, and they can drive price on a short-term basis higher or lower through manipulation. So if they're going to manipulate price on the short term by having large orders come in and push and bully market pricing around, they're going to want to liquidate those positions because just like anyone else, they don't want to incur losses. So this gives them the opportunity to mitigate those losses. Premium price highs are bought by less informed traders and sold by smart money. Which are you going to be grouped in? Okay, folks, we're going to look at a quick example. And I'm going to draw your attention to a liquidity void in here. And there's equilibrium of that liquidity void, body to body end, or is the open and close. And we're going to highlight that reference point here, so halfway point of this equilibrium. The idea is we broke this high back here. We're expecting continuation on the upside. Market trades higher, but it shows a breakdown in here. Okay. In here, this failure swing right there, we're going to be looking at this low. And I'm just going to drop horizontal lines in on the respective lows. And this will be a new mitigation block when we drop down into the lower time frames. Market should sell off there. It sells off, breaks this low here, so the last down candle on this move here is there. So once price trades back up, that's a sell right in here. It just overshoots it by a little bit, but nonetheless, it breaks lower right here. So now our attention is on this low. Every rally that sees lower prices needs to be mitigated right here. So if we trade back up to that low, that's a sell. Right there is a sell. We're going to be aiming for a move back below this low, ultimately down into our equilibrium of our liquidity void right here. Low comes in at 111.48, 111.48. Here's a short-term low, hits it, trades lower, trades back up into the last down candle, hits it, overshoots a little bit, but it's inside the body of the candle, which is what a mitigation block represents. Price trades down below the last down candle here, and we have another lower low here, so we can adjust that one to that low there, right there. Price hits that. Objective is going to be break below this low, sells off, goes through it, and ultimately goes down into our mean threshold of the liquidity void. So a couple different things shown in here as an overlap study on mitigation. Let's take a look at a 30-minute chart on the same price action. Here's a mean threshold of the liquidity void. Last down candle, wait for the up move. Price hits it, sell it right there. This is a mitigation block. Everything that was used to drive price higher, once it's traded below here, it's underwater. They're going to want to mitigate those losses at that candle, sell short. This last down candle here is violated here. If price trades back up to it here, we can be a seller. The body's whole entire candle is used, not just the bottom, but we can be a seller down here. So it could be a short seller at 112.62, and our stop has to be somewhere above the down candle in here. Okay, so that high on this candle comes in at 112.89, so it needs to be above that in the form of a stop. So we could be seeing just a little bit of drawdown in here, about 20 pips or so, but never getting much above this down candle. Price trades lower, violates a very convincing break down here. Last down candle, the low, trades up. Now again, notice the body of the candle is not violated. This is hallmark characteristics of a mitigation block. Price trades up into it. We're expecting prices below this low now, and then ultimately reaches down into our mean threshold of the liquidity void. Then ultimately, I'll give you a view of what took place. Price eventually started to move back up. So hopefully this has helped you with mitigation blocks. We will still talk more about it again in the PDF file for your December 2016 ICT mentorship study notes. Until next time, I wish you good luck and good trading.